As of right now, we're recording the class. So what is getting recorded? I want to be transparent about this, okay? Two things are being recorded. Number one is any audio that my laptop picks up is being recorded. That's number one. In fact, I'm going to plug the laptop in so that it won't shut itself off over the next hour. The second thing that's being recorded is whatever is on my laptop's screen. Okay? So it's not, don't worry folks, it's not going to be a video of me, all right? For sure. I did not turn on the video part of my laptop little camera, okay? So it will pick up audio and it will pick up whatever's on the screen. So, and then it will be saved as a video file, and I'll post it up to Blackboard. Okay, so it'll be pretty easy to pull off and not pay attention for the next hour, and then listen to it when you're having trouble sleeping sometime. Okay, so where do we stop last time? I think we were about here, right? Yeah. Does anyone need a copy of the slides? This last class, we got to bring their slides. I have a few up here if you need them. Okay, and I drew this on the board last time, a downward sloping line that depicts the relationship between yields on the horizontal axis and bond prices here on the vertical axis. So what do we care about? We care about knowing what happens to bond prices when yields change. So what happens when yields go down? This way. That's right. Inverse relationship. Okay. So let's say we're standing right here. Okay. Yields are between 6 and 7%. My bond is priced at $1,100. We know that yields decline, the price will rise. We know that if yields rise, my bond's price will fall. Okay? So that's an important relationship that I expect you to know and understand. If you forget, you can just plug in a different yield in your calculator and see what happens to prices. We're going to do that in a minute. Yeah. This is a fictional line, but it's also accurate. Okay? Yeah. So what that means is that let me say it a little bit differently. This isn't the same for every bond that's out there. You might have another bond that is a little bit flatter of a line. Still downward sloping, Antonio? Still downward sloping, yes or no? Yes, but a little flatter. You might have another bond that's really, really steep. Still downward sloping? Yep, just steeper. And so that's what we're going to talk about next. Like what will cause a bond's line to be flatter or steeper? Correct. In fact, two different types of interest rate risk. Interest rate risk is what will drive the steepness of this line. And interest rate risk can be divided up into a couple of categories that we have to discuss. All right? But right now, which bond, let me come to a couple conclusions. One, for all plain vanilla bonds that we've talked about, they're all downward sloping. Okay? And two, they're convex to the origin. So notice when I draw the line, is it ever straight? No, it bends away from the origin. That's called convexity, the bond's convexity. And that's the case no matter what. And then it's just a question of how much. So when you're investing in bonds, What did we see last time? We saw that a bond's price can go up or down when interest rates change. And we saw, you guys asked some good questions at the very end, okay, especially that, for example, if we have a bond, and we have a bond, let's actually come up with a new slide. We have a bond. When that bond is born, the coupon rate equals the yield to maturity of 10%. Okay, for example. Okay. And at that time, when the bond is born, the price of the bond is $1,000. Okay. So when the bond is born, here's the world. The world is good, right? Which of these numbers is fixed, and which of these numbers will fluctuate? Only one of these numbers is fixed. Which one? The coupon rate is fixed. And that dictates the coupon payment that the bond will make. That's fixed. Then what happens? Yields change. They go up and down. And so when the yields change, the prices change. Okay, that we got. So let's see how good we know this. What happens, all right, if the bond is selling at a premium? If the bond is selling at a premium, what had to have happened to yields? See, the price went up, so what happened to yields? They had to go down. Right? Think about it like this. Let's say yields go down to 8%. If yields went down to 8%, then that means new bonds that are coming out are paying $80. This bond is paying at $100. So it's going to be more attractive. So when the coupon rate is greater than the yield to maturity, the bond is going to sell at a premium. Now this is messy, but it just says it on this next slide. When the coupon rate is less than the yield to maturity, think about coupons as what your bond is paying. Yield to maturity is what other bonds might be paying. Then your bond has got to sell at a discount because it's less attractive. Yeah, the market rate. It's a good way for us to think about it. I think we've been talking about it like that, but I flip kind of back and forth. And so understanding that is important. It's all out here on the slide, but we just talked it through. So if you invest in a bond, what are the different things that you lose sleep over at night? I mean, think about it. I don't have a lot of money. But you guys know from the problem that we did that I have like $200,000 in my kid's college savings account. And that's kind of important, right? I mean, if that thing doesn't pan out right, if the stock market tanks, then it's a world apart for me, right? So what types of risks do you lose sleep over at night if you invest in bonds? That's number one, right? So you ever watch that show Family Feud, and there's like they rank these answers from these public polls? That would be our number one answer. That's right. The risk of the company that is responsible for paying you back. That's definitely a top three, depending on the company, right? If it's Google, you're probably not that, and it's a bond that's only 2 years before it matures. You're like, how risky can Google get in 2 years? Probably not much different than it is today, right? 20 years maybe, but 2 years not so bad. So you're worried about interest rates, you're worried about the company, and then you might be worried about different events that occur around the world, like disasters, right? Something like that. They can affect financial markets. Again, you have no control over any of this stuff, but these are the things that you worry about. So what I wanted to do is talk to you a little bit more about, we're going to talk about the company-specific risk on Tuesday. Today, I want to talk to you more about the interest rate risk. Okay. So the interest rate risk, we're going to divide up into two pieces. Okay. One, we've already seen. If the risk of the bond's price going up or down when interest rates change. That's what we were talking about? And so that's very important. But there's another type of interest rate risk out there. And it's called reinvestment risk. Reinvestment risk. And that's a little bit different. Again, price risk is the risk of the price of the bond going up or down when interest rates change. Got it. Reinvestment risk, we can think of, maybe if we consider two different examples. Let's say you have some money that you have invested, and you have a goal. And your goal is to retire in 20 years. That's considered your horizon. So your horizon is 20 years. What are your choices for buying bonds? Google has 3 bonds outstanding right now. One is a 1-year bond, one is like a 2 or a 3-year bond, and one of them is a 10-year bond. Did you choose any of those? None of those are 20 years, though. Then you choose another 10-year bond, right? So we could choose to invest in Google's 10-year bond, and then 10 years from now, invest in another 10-year bond. Could we invest in Google's 1-year bond? Sure. And then do another 1-year bond, and another 1-year bond. You get the picture. Maybe not Google's, but we could invest in a sequence of 1-year bonds. Now, does everybody see that no matter what, your horizon is the same? It's just a question of how frequent you have to reinvest the money that is that you're going to get back. Which one of these do you worry more about what the interest rate will be when you reinvest the money? Remember, when we say reinvest, what does that mean? I'm going to lend Google money, and they're going to give me $1,000 here in 10 years. When that $1,000 comes in the mail, that check, I'm going to turn around and I'm going to reinvest it for another 10 years. So this is where I have to be worried about the reinvestment rate. So how many times does that happen for this first investment? Investment A, choice A. One time. One time you have to worry about where interest rates are at in terms of your reinvestment. Here, how many times do you have to worry? 19 times, right? We only know the first one. I know the interest rate today for a year. The next 19, no idea. So is it safe to say that investment B will have the greater reinvestment risk? Can it work for you? Sure. Against you? Sure. So think about the risk more like not to work for or against you, but the uncertainty. There's more sources of uncertainty for reinvestment in this choice B, than this one. 19 times. You got to worry about where interest rates are. So right now, you guys are thinking, wow, there's a lot of reinvestment risk in this. Who would do that? I would definitely choose A, and a lot of people do. But which one of these bonds has the higher price risk, do you think? And for this one, I don't do this often, but I'm going to point to the algebra. We know that the present value of something, the value of a bond, okay? Let's say the present value of the future cash flows, okay? So the present value is the present value of the future cash flow stream. And what do we care about? Well, I have a number. The price of my bond is $1,000. Right? If I changes, is it safe to say that the present value is going to change? Yeah, and we know how. When I goes up, PV goes down, and vice versa. What will make it magnified? If n is 1 or if n is 30, for example. Or in this case, in our example, we can either have a 1-year bond or a 10-year bond. 1 plus I raised to the first power is just 1 plus I, right? 1 plus I raised to the 10th power, that's an exponential, right? I mean, think about what that does to the denominator. Raising something to the 10th power will explode the denominator, will it not? Thus, it will also explode any changes in I. But forget about this crap. Let's go through an example, right? And we'll be able to see it. But one thing that we'll see is what we're coming to the conclusion of is that long-term bonds, like the 10-year, will have less reinvestment risk and more price risk. But forget about this for a second. Let's take a look. So this is this example of we have two downward sloping lines, and one of them is fairly flat, and one of them is fairly steep, at least steeper. What's the difference between the two? Can you see it? This is a busy graph. Right? What's the difference between the green line and the blue? The green line is the 30-year bond. The blue line is the 1-year bond, right? And this is the price-yield relationship. Notice we're starting at the same point for both of them. Right? So let's play a game, all right? And the game is, today, interest rates are at 10%, and the price of both bonds is $1,000. So are those two bonds created equal? Well, they both have the same yield, 10%. They both have the same price of 1,000. But what happens to them if interest rates change? Do they react the same way? No. Which one reacts more? The green, right? Look at how steep that is. And in both directions, right? So if yields, if interest rates, if market rates decline, both bond prices go up, but the 30-year bond will go up by a lot more. I mean, you're happy with both investments, right? I mean, you spend $1,000 on each bond. The 1-year bond, that price goes up by 48 bucks. Well, look at the 30-year bond. That's that explosion of that exponential in that denominator. Except raised to the 30th power. And so you can see that price change is really, really magnified. But it works to your detriment, too. That if yields go up, both bonds go down in price. But which one would you rather own if interest rates go up, the 1-year or the 30-year? The 1-year. Neither of you can help it, but if I force you to make a decision, the 1-year bond. Because the 30-year bond value gets cut in half. So, what's the rule now? The rule says the longer a bond's maturity, the more sensitive it is to a change in prices. So let's think about this for a second. So long maturity bond, you will get greater sensitivity in price to a change in yield. So price risk is large. But what do we say way back here when we talked about reinvestment risk? The 1 year versus the 10 year. Which one has more reinvestment risk? The 1 or the 10? The sequence of 1 year bonds have a lot of reinvestment risk, which means the longer the maturity, the less reinvestment risk you have. Okay, so long maturity bond, less reinvestment risk. Okay. So if you have a long maturity bond, less reinvestment risk, but a lot of price risk. Short maturity bond is the reverse. Okay. Everyone okay with that? Just a couple of concepts. All right. So far, what's the idea here, folks? The idea is that we're kind of talking about risks and understanding the different risks of investing in this security, in these ideas, in these loans. Last class, we spent a lot of time figuring out how to value bonds, right? And in that, we had the future value, we had the payment, we had the interest rate, we had the maturity, and we found present value. That's not how the world really works. Most of the time, you have the price of something. It's sort of like me asking you, what should the price of this calculator be? Well, you can just look it up on staples.com, what the price is of this calculator. Or what would you rather do? Would you rather look it up on staples.com or Amazon? Or would you rather find what the component prices are, buy them, pay somebody to put them all together, and see what that ends up costing you, and then doing a demand analysis to see what you could then charge above and beyond that for what people would pay? What would you rather do? Pretty easy, right? Look it up. Couldn't we do the same thing for bonds? Bonds are very liquid securities. They're like stocks. They change hands every day. So Google's bond, we're going to see what they're priced at in a little bit. Hey, in fact, let's do that now, just for kicks, because, why not? All right. So there's a website called finra.org, okay? And that's the one that I'm on now. And it helps us find different prices of bonds. Okay? So instead of trying to value Google's bonds, doing what we did yesterday, it seems like so long ago, doesn't it? It was just yesterday, believe it or not. Instead, why don't we just look up the price? So these are the three bonds, these are the three loans that Google took out a couple of years ago. So they took out a loan. With these three loans, they borrowed $3.5 billion total. Some of it they're going to pay back in 2 years. Has a coupon of that's right, a coupon of 1.25%. You invest in these bonds, it pays you $12.50 per year, or $8,000 you invest. This bond's got 4 years left, and it pays you $21. This bond's got, 9 years remaining? It pays you $36 a year. How much would you pay for these bonds? Well, let's look at them. All right, I know their maturity. They're callable. That's kind of weird. We didn't talk about that yet. We'll do that Tuesday. It means that Google can choose to pay you back early if they want. These are three different famous ratings companies, Moody's, S&P, and Fitch. You can see that 2 of the 3 report here. And we're going to talk more about bond ratings on Tuesday as well. These would be Rated high or rated poor? What do you think? Ooh, high, right? AAA would be the highest. And these are just a notch below that. Definitely investment grade bonds, high quality. These are their prices. The thing about prices is that we've been talking in terms of like $1,000, right? Like when we calculate a bond price, it's like 900, 90, 1100, 1200. This looks really low, doesn't it? Bonds are quoted as a percentage of par. And we know that par is $1,000. So 109% of par is going to be 1,090. Or just move the decimal place over one. And that's the price of this bond. This bond, we have to pay $1,098.76. So how do we draw this bond out? If we draw it out, I build a timeline, and this bond would pay $36 in coupons total each year for 9 years, and pay $1,000 at maturity, and the price of that bond would be $1,098.76. So you actually know the prices because other people buy and sell them. So what do you care about? You care about the return that you get if you choose to pay for the bond. Right? So the return that you get when you buy the bond is the yield to maturity. So folks, instead of having a bunch of data and calculating the PV, we're going to have a bunch of data and calculate alpha. That's the one that we care about. As you can imagine, it's not that hard as long as we have the data and we remember to put the present value in as a negative when we're going to buy the bond. So for example, here's a bond, 10% annual coupon, 15 years to maturity. We observe the bond's price, $9.28, and we know it gives us $1,000 at the end. Plug it in, solve for I, and get 11%. Is there anything in here that we don't know how to do? I hope not, right? I know how to get N, present value, future value. I know how to translate the coupon rate of 10% to a coupon payment of 100, solve for I. Fair enough? Okay. What happens though, I've been dishonest with you. I've been dishonest because most of the examples, or all the examples we've used so far, have had annual coupons, and most corporate bonds pay coupons twice a year. And so what that means is that you still get the 10% total, but it's split 5% the first 6 months, 5% the second 6 months. Does that change things? Think about the cash flows. If the cash flows change, then it changes things. Apple and an orange. So in this case, with semi-annual coupons, we have to plug things in a little bit different. Instead of, so this is a separate example, okay? So we got a 10% coupon rate. That's going to translate to a total amount of coupons paid of $100. But twice a year, we're going to get 50 instead. So the payment's going to be 50. Future value remains at 1,000. We're going to plug in our price that we observe of $11.97. And then what happens to this? It's a 20-year bond, but we have to put in how many coupons we get. So do we divide by 2 or multiply by 2? We multiply by 2 and plug in 40. When we compute I, I'm even going to cross this out for a second. Right? When we compute I, our calculator is going to give us 4%. Probably. But remember, if we haven't mucked around with our calculator settings, we have to match the payment with the rate. So the payment we get every 6 months, right? So this is our 6-month yield. So how do we annualize it? Just double it. We need to double it. Remember, your calculator will spit a number out at you that corresponds to the frequency of your payments. If you have your calculator setting at 1 per year. If you want to change your calculator settings to 2 per year, you don't have to do this last step. It'll give you the 8 automatically. So you either have to remember to change your calculator setting or multiply by 2 at the end. So you want to make sure that you can get 8%. The goal is to arrive at 8%, full stop. Okay. So what does this number mean? How would you interpret this, 8%? We calculated the bond's yield to maturity. Do those exist for Google? Yeah, here they are. Right. So for those 3 loans that Google took out, one has a yield of 0.4% a year, a little less. This one has a yield of just under 1% a year. This one has a yield of 2.4% a year. This last column is yield to maturity. So I will also tell you that this is the number that I would hug if I could. This is the one that we care most about as investors. Sorry about that visual. That's no good. You're still even with me. Most of you guys, like, your eyes are glazed over. You're just like treading water for like another half hour or something like that, right? Sure. Okay, this is the number that we care most about. Why? Because this number tells you your annual expected return total from lending money to Google. 2.4% a year. But I thought the coupon was 3.6. Right? So aren't you getting, in this case, $36 a year or $18 every 6 months? Yeah. But you got to pay an extra $100 for this bond, right? It's not selling a car, it's selling an A. So remember that what we saw at the very beginning of this class. When you have a bond that's selling at a premium, the coupon will be greater than yield to maturity. And it's that whole intersection triangle thing. Forget about that for the moment. Let's think about this example. If you lend this company money, your total return that you get for the year should be 8%. You're like, so what, right? Why do we care about that? Well, because this is just a total, but your return comes in different forms. So what are the benefits that you get from an investor investing in stocks or bonds or something else? 2 things, right? You can either you invest in a stock, all right, that you pay, what's Facebook trading at now? Let's just call it 32, okay? So you pay $32 today, that's P0, price today. $32 for 1 share of Facebook. Right? Let's say fast forward a year, you're going to sell it. What do you hope to sell it for? Yeah, you hope the price goes up. You don't know, but you hope the price goes up. Let's say it goes up to $35 or so. Okay? So, does that make you happy or sad? Probably pretty happy, right? It went up by about how much? $3. Okay? And if you translated that to a percentage return, what would that be? About. Well, $3 over 32, it'd be like 9%. Well, let's actually do it. Okay? So, went up by $3, divided by 32, 9.4%. Okay? So everybody see what I did? I took the difference and said we made $3, but on an investment of $32. So on a percentage basis, that translates to 9.4%. That is what we would call our capital gain. 9.4%. It's a lot easier if we work in increments of 100, right? But that's not what Facebook does. Right? said, well, Facebook, you bought it for 100 and you sold it for 110. What's your return? 10%. Well, how did you get that? Take 10 divided by your initial investment. That's all we're doing. Okay? What if during the year, Facebook also pays you a dividend of $1? Does that make things better or worse? Yeah, because you still got the 9.4%, and you also got a $1 dividend. So we also have to figure out what we're going to call, this kind of get us used to some of the terminology in stocks, right? A dividend yield. We make money off of the cash that we get. And that's going to be translated to a $1 dividend divided by an investment of 32. So what's that going to get us? That's going to get us another 1 over 32. It's about 3.1%. Okay. 3.1%. So does everyone see that if we bought Facebook today, it paid us $1 during the year, and we sold it at 35, that two things happened. We got a little bit of return, 3%, off of our original investment from the cash. And we also got a price bump that gave us some money at the very end. What was your total return from investing in Facebook? Yeah, 12.5. You got to sum these two up. You got 9.5 from the price change, and you got another 3 from the cash. So your total return from investing in Facebook is going to be 12.5%. Now, what on earth does this have to do with Chapter 7 and bonds? That's where we're going now. Do bonds prices change? Yeah. Anytime interest rates change or anytime something else happens, bond prices change. Do bonds pay cash? What do we call those? Coupons. So we could do the same thing for bonds that we did here for Facebook. Right? So let's so I'm going to create an example using the bond that we just did. So the bond that we just had from, this is way back when, this is here, okay? So take a look at this bond, all right? I'm going to translate some of the data. What's its price today? $1197.93, okay? So this bond's price today, so I'm going to put P0. So this bond's price today is $1197.93, all right? What else do we know about this bond? This one. Okay, that's okay. My fault. Right. So we know a little bit more about this bond. How many payments does this bond have remaining? Okay, N is 40. I'm translating it here because I need kind of a blank sheet. Okay, and if I wrote on the board, then it wouldn't get recorded. Okay, so N is 40. We know that what else do we know? Do we know the face value? Yeah, it's 1,000. Okay. Do we know the payment on this bond? 50. All right, and that happens 2 times per year, right? Fair enough. And then the other characteristic that we know from the problem is that yields were at 8%. So this is just copying down the data from that slide a couple ago. Yeah. The coupon rate is 10%. Okay. Which translates to $100 total, but twice a year. Exactly. I like the erase. It's like I'm coloring. All right. So here's the situation. The question to you is, can we determine the different sources of return for this bond for just this year? first year of the bond's life. Right? So what do we need to know? If we're doing like the Facebook example, we would need to know the price at the beginning. Do we have that? Yeah. 11.97.93. We would need to know the cash flow that the bond pays during the year. Do we know that? Yeah, that's 50. Oh, that was a loud yawn. And 50. And then, so this is the cash. And then we would also need to know the price at the end of the year, wouldn't we? And we don't have that. But then we could do everything that we did with Facebook. Can we do the cash yield now? Okay, so when we did Facebook, we just took the dividend, divide by the beginning price. Right? So what would we do here? We take the cash and divide by the beginning price. That's our number one for today, okay? By the way, this whole problem is like the biggest takeaway from class today, right? That if we can do this problem, then you can do a lot of stuff, right? So in the world of stocks, cash that is paid out is called the dividend, and this is called the dividend yield. In the world of bonds, this is called the bond's current yield. This means what are you getting the next year? Remember, like in accounting, a current account is something that happens over a year, right? Current asset, current liability. Same thing here. How much cash are you getting this year? So this bond's current yield. What's the total amount of cash that this bond is paying you this year? That's right, 100. And the price that you're paying for this bond is $11.97.93. That will give us a measure of the return from investing in this bond that's associated with the cash that they pay you. Too many big words in there. This is just the cash yield that you're getting. You're going to spend $11.97. They're going to pay you $100. What kind of a return is that? Right? And when we do the math out, I'm going to take it to a couple decimal places. You should get 8.35%. Right? So it just says, hey, if you invest in this bond, it's going to pay you 8.35% back in cash. Everybody okay with that? All right, so we've taken care of the cash that the bond pays. So all we have left is to figure out the capital gain yield. So how do we figure out what the bond is going to be worth 1 year from today? How are we going to figure that out? I want you guys to think about it for a second. All right? Think about what it's going to be worth and how you would figure that out. You have to figure out how to value a bond given the life that remains in the bond. It seems kind of tricky. There are a couple different ways to do it. I'm going to give you the way that I think is easiest, but you might come up with another way. Patricia, what do you want to do?
I thought maybe, I don't know.
Throw it out there.
If you want to find for 1 year, like, the formula that you use and by 1, 39.
That's exactly right, but I'm going to make one adjustment. And that's that a year from now, how many payments will remain? Right? Because there's 2 payments that happen, but that's exactly right. I mean, fast forward a year, right? Close your eyes, go to sleep for a year. Sounds kind of nice, right? Close your eyes, go to sleep for a year. How would you value that bond? Well, the payment would still be 50. The future value would still be 1,000. We're going to assume for now that interest rates remain the same, just for now. What changes? And if we fast forward a year, there's less time remaining in the bond. So there are fewer coupon payments. How many fewer are years from today? 2 years. Okay. So another way to think about it, folks, is to draw out the timeline. Right? That really, what we're doing is we're valuing a bond that has, I draw this how many times? 38 times, right? This is what we're valuing. Okay. Only looking at the problem like this. So as if I told you to wake up in a year and tell me what the bond is worth, it's worth the present value of the future cash flow stream. Well, what's the future cash flow stream in a year? Everything that happens after. So that's the way that I think is most intuitive. And so to do that, I'm going to put it in this little box over here. All right. Get crowded in a second. Future value is still 1,000. Right? N though is what? What did we say it would be a year from now? 38. Rates remain the same, but remember that our payments happen every 6 months. So what do we have to put this in at? We have to put this in at 4. Okay. What else is the same? Payment is still 50, and we solve for EV. And what do we end up with? I got 1193.68. 1193.68. And that's the expected price of the bond 1 year from now. The expected price of the bond 1 year from now. 1193.68. Does it look right? Or does it look wrong? It certainly looks weak, right? The price went down. That's counterintuitive, right? It's like you would actually expect the bond price to go down. Why would you buy something where the price is going to go down? Why would you go buy that? That's right, because you make it up in the coupon return. So you lose a little on the bond price, but you make it up here. So what's your return on this? Antonio, question or answer? Go ahead. It goes down because you're more than making it up, okay, with the current yield. Hold that thought for a second, all right? Just for like maybe more than a second, like 2 minutes. And then hopefully the puzzle will reveal itself, okay? So what's the capital, and in quotes here, I'm going to put gain, okay? Even though we know that it can go down in value. Hang on, it has nothing to do with market. How did we get this here? What did we do? How did we get this 9.4%? Because that's that calculation that we're going to do. You have to do the difference between these two, divide by the beginning price. Okay? But when you take the difference between these two, you got to put it in the right direction, right? So here the price went up, so we had a positive number in the numerator. Divide by the price we paid. So in this example, the price went down, correct? So we got to make sure that we put it in the right way. 1193.68 minus 1197.93 all over 1197.93. And when you do that out and you take it out to a few decimal places, you end up with a negative 0.35%. So, which makes sense, you lost money on the bond's price. You lost money on the bond's price. What's your total return from investing in this bond? Why don't you go ahead? Okay, so that's the total amount, right? And on a percentage basis, what does that translate to? together, 8%. You see the number anywhere else? It better tie out to our yield to maturity. So at the very beginning, 3 slides ago, we calculated the yield to maturity for this bond as 8%. And we said that's the total annual return you expect to earn if you invest in this bond. Do you expect to lose money on the price? Yes. And you more than make it up on the tax that bond is going to pay. Now I'm going to get back to your question. So first of all, the puzzle has to work out. The puzzle has to work out. And then the other thing is, what's going on here? Why would we expect this bond's price to decline over time? And I'm going to draw a picture. What do you think this bond's price will be? See, this is a 20-year bond, right? Okay. So 20 years from now, let's say you got the bond and it's about to pay you $1,000. So I want you to go to sleep and I want you to wake up 19 years from now plus 364 days. Okay. Not quite nice, right? Okay. So what would you pay for this bond? It's going to pay $1,000 tomorrow. What would you pay? But pretty close to 1,000, right? I mean, you got an investment that's going to pay $1,000 tomorrow. It's going to be close to $1,000, right? How about 2 days before? Well, it's still close to 1,000, but maybe a little bit more. So here's what we know. What if this bond was going to mature 5 minutes from now? Pretty much $1,000, right? So there's a fact. And the fact is, when this bond matures, it will sell exactly for $1,000. Fact. All right. So we know the price of the bond. Price of the bond in year 20 is $1,000. Full stop. Can you value a bond today? Sure. What if you calculate a bond's price today, okay, here's the bond, and the bond is priced today at $980. Right? Or we just do one of our bond valuation problems, and it's $980. It's selling at a discount. P0 is $980. Fact. So we have 2 facts here, folks. Price today and price exactly 20 years from now. What's the only way to get from 980 to 1,000? The price must do what between now and then? It has to go up over time. It has to go from 980 up to 1,000. What if you calculated a bond's value and it's selling at a premium? What would you predict would happen to the price of this bond over the next 20 years? It has to decline. And we could do this, we're not going to, right? Well, I'm going to miss you guys over like the next 5 days. So maybe for fun, tomorrow night, I'll calculate the price of the bond in year 1, and year 2, and year 3. And you get a picture, right? And you can see the bond's price migrate. And it happens because of the relationship between yield to maturity and the coupon and the interplay between the cash you get and the bond's price. Another way to say it is, hey, if they're paying you more than what they need to in cash, you got to make up the difference somehow. You're going to lose a little bit somewhere else. You gain a lot here, you lose a little bit here. No matter what, you're going to end up at a total of 8%. What would happen in year 2? Same thing. You would end up with a total of 8%. But this would be a little bit different. This would be a smidgen different, and this would be a smidgen different. All right. Is this a good place to stop for today? Okay. But also, that's what this slide says. But I'm glad we worked it out on our own. So when we come back on Tuesday, we're going to spend 10 or 15 minutes talking about bond characteristics, and then we're going to do 2 hard bond problems. All right? I'm so excited. Over the weekend, look for this posted. I'll send out an announcement when I figure out how to do that. I'm also going to email you. There's a tutoring that Babson offers you. It's the Start Tutoring. And it is for summer. It is for finance. I've checked with Rachel Riser. So you'll have a couple different sources, me and one or two other folks, okay? And then I will also post the review problem set over the weekend. You guys have a great holiday. Do not think about finance at all for the next 5 or 6 hours. You'll see what you can do. For corporate bonds, let's see if I can see how I can do this. Just want to make sure that I don't screw this up. That should be good. Okay. So corporate bonds, the par value is typically 1,000. Government bonds, it's either 10,000 or 100,000. Just like a pizza, right? Typically, it's like this. Even a bigger pizza or a smaller pizza. I would say it's up to you. If you have Verizon, okay. So Verizon, you're sure that there's an industry average. The library posts something about how to get data by industry or whatever. So you do an industry average. But if you don't believe those numbers, just the way that the industry is defined is a little weird perhaps, then you can, if you have like one peer company that you think is a good match, that's a good alternative. If you have a pair of them that you think, well, here's a smaller company that's like them, here's a bigger company that's a little less like them, but closer to the size, I kind of leave it up to you guys to decide. I never say that's bad. You guys already know more about that. Okay? Okay. You too. This is probably still recording. Bye, guys.